Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2. This is Section I, and this is an application topic. It's actually a continuation of the previous application topic from the previous two videos. Prepare journal entries to recognize equity transactions in the financial statements, and we're covering capital account activity in pass-through entities specifically in this video. Remember, we've been dealing with the same blueprint topic for the past two videos, and now also in this video. And we covered stock issuance, stock dividends, and stock splits in the first video, treasury stock in the last video, and now again, capital account activity in this video. And we're going to be doing that the Superfast CPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you check out and sign up for our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing these difficult exams. We will teach you how to be effective and efficient with your studying each day. So again, make sure you check out that webinar. And after you check out the webinar, you'll probably want to learn more. So make sure you check out becoming a Superfast CPA Pro member, because in today's video, we're only going over 5 questions, but Superfast CPA Pro members get access to the full 10 question videos so that they can get more practice and a little bit more understanding by, again, getting access to those 5 extra questions. So make sure you check out becoming a Pro member. You get access to the Pro course where we teach you exactly how to study every day, all the way until you're done with the exams. And again, you get access to the full 10 question versions of these videos. With all that said, let's go to the questions for this video. All right, here we are at question 1, and something we always like to point out in these videos is you want to go to the last part of the question first. Now, it may not seem very useful when you are learning the material and you're doing questions that are all kind of similar to each other, but you want to get into this habit because on test day and whenever you're doing review, you have no idea what you're going to be seeing. So you want to make sure that you give yourself the best chance of understanding quickly what the question is asking for. So you read the last part of the question first to give yourself context so that as you're reading through the rest of the question, you have a little bit better idea what you're even looking for or what you're even dealing with. So again, read the last part of the question first. It will give you context. So let's read the last part right here. Based on these contributions, what is the initial capital account balance for each partner in ABC partnership? Okay, let's go to the top. Elena, Ben, and Kara have decided to form ABC Partnership, a pass-through entity. Each partner is contributing different items to establish their accounts. In the partnership below is a summary of their contributions. Elena contributes $50,000 in cash and land with a fair market value of $80,000. The land originally cost $70,000. The land has an outstanding mortgage of $30,000, which the partnership will assume. Ben contributes equipment with a fair market value of $60,000. The equipment originally cost $90,000 and currently has a carrying amount of $50,000. He also contributes $10,000 in cash. The equipment still has a remaining loan balance of $5,000, which the partnership will assume. And then finally, for the last partner, Kara contributes $40,000 in cash and inventory with a fair market value of $25,000. The inventory originally cost $20,000 and has a carrying amount of $18,000. Okay, so a lot of information there. Again, we need to figure out, based on these contributions, what is the initial capital account balance for these partners in this partnership. Now, this is pretty different from what we've gone over in the previous videos, and this is something that I used to think wasn't necessary to go over, but now that the blueprint topic specifically talks about it, that's why we're going over it. So if you have any idea how to do this, if you've dealt with this before, definitely pause the video and give this a try. If you have no idea how to do this, that's okay. We are using these questions to learn how to do the material, so let's go ahead and dive into the answer if you haven't paused the video. All right, here we are. The answer is A. Elena would have $100,000, Ben would have $65,000, and Kara would have $65,000, and these are all their initial capital balances. So let's go through this. To calculate each partner's initial capital account, we base it on the fair market value of each contribution minus any liabilities the partnership assumes. So let's go through this. It's not too difficult once you understand the rules for it. So the cash just always has its own fair market value. Whatever cash you donate, that is the fair market value. So Elena gave $50,000 of cash. And then for any property or assets donated, like non-cash property, it's recorded at the fair market value. So the land had a fair market value of $80,000. So that means that's how much is included. So $50,000 plus $80,000, she's at $130,000. But you also subtract any liabilities that are assumed from the partnership that, basically the partner is not going to be responsible for that anymore. So kind of as a way of making sure they're not getting too many benefits, getting it taken away and the land still being recorded at the full fair market value, you subtract the mortgage from the total. So $50,000 plus $80,000 less the $30,000 mortgage gets to $100,000 for Elena's initial capital account. Now we go to Ben. He donated $10,000. Again, that's just the fair market value. Equipment had a fair market value of $60,000, so that's what we use. And then he also had a loan that was assumed by the partnership. So we subtract that $5,000 loan. So he's down to $65,000. And then Kara is a little bit easier. She donated $40,000. She donated inventory with a fair market value of $25,000. And she didn't have any loans or debt or anything that the partnership took on. So she's at $65,000. So as you can see throughout this, the original cost and carrying amounts of assets contributed are additional information, but they do not affect the capital account calculation because it's based on cash and the fair market value of anything that's donated. And then you, of course, subtract any debt or liabilities that are taken on by the partnership. And so the partner is no longer responsible for them. So that's how you calculate the initial capital account balance for, we're dealing mainly with partnerships in this video. So that's how you do that. Now let's go to the next questions to start building on what else can happen to affect the capital account. All right, here we are at question 2. What will be Yolanda's capital account balance after Zara is admitted to the partnership? Xander and Yolanda are partners in XYZ partnership. Their current capital account balances are $180,000 and $120,000 respectively, and they share profits and losses in a 70-30 ratio. And so that would mean that Xander is 70% and Yolanda is 30%. The partnership agrees to admit Zara as a new partner. Zara invests $50,000 in cash for a 25% interest in the partnership. The partnership uses the bonus method to record the admission of Zara. So with all that information, again, we're using the bonus method. We haven't talked about that yet. She's being admitted to the partnership. How does all this affect Yolanda's capital account balance? So if you have no idea how to do this, that's okay. Again, we are using these questions to learn how to do this. But if you have any idea or if you've dealt with something like this before, take this moment to pause the video and practice it on your own. And when you're ready, come back. We will look at the answer together. All right, here we are at the answer. The answer is A, $108,750. That's how much Yolanda's capital account balance will be after all of this. So we will be going over the bonus method for adding a new partner to a partnership. So let's walk through it. So at the beginning, you first have to figure out what the new total capital account balance is. So you take Xander's capital plus Yolanda's capital plus Zara's contribution, which was $50,000. So $180,000 plus $120,000 plus $50,000 is $350,000 of total capital. Now, why is that important? She gets a 25% interest in the company. That means 25% interest in the profit and loss, and also 25% interest in the capital. To give Zara a 25% interest in a $350,000 partnership, her capital balance should be 25% of $350,000 or $87,500. Since Zara only contributed $50,000, the additional $37,500, which is the bonus, must be taken from Xander and Yolanda's capital accounts in their 70-30 ratio. So the bonus method basically means that somebody contributed something to become part of a partnership, but what they contributed isn't equal to how much their capital account balance is supposed to be based off of their ownership percentage after joining the partnership. So that difference, that amount that needs to be added to their capital account is a bonus. The bonus is taken out of the capital accounts of the other partners. And again, it's in their ratio. So Xander's share of the bonus is $37,500 multiplied by his 70%, so $26,250. Yolanda's share of the bonus is $37,500 multiplied by 30%, so that's $11,250. And the reason we needed to calculate that is obviously so that we know how much of the bonus is being taken out of Yolanda's account. So she originally had $120,000, but the bonus that is allocated to Zara, 30% of it is taken out of Yolanda's account. So we take $120,000 less $11,250, and that's $108,750 that Yolanda now has as her capital account. So that's how the bonus method works. Again, this is when a partner contributes a certain amount, but their ownership interest dictates that they should have a higher capital account balance. So that difference is the bonus, and that bonus is taken out of the other partner's capital account balances proportionately, and then that will affect, of course, their account balances, and that will get the new partner's account balance up to what it should be. And again, that's how you use the bonus method. Now let's go to the next question to learn about a different method. All right, here we are at question 3. What amount of total goodwill will be recorded by the partnership upon formation? So let's go up to the top. This is something different, obviously. Alice, Ben, and Chloe decide to form ABC Partnership. Each partner contributes assets as follows. Alice contributes equipment valued at $100,000. Ben contributes a building valued at $150,000. Chloe contributes cash of $50,000. The partners agree that they will each have an equal 1/3 interest in the partnership. The partnership decides to use the Goodwill method to account for the formation. So we're using the Goodwill method. If you have any idea how that works, then great. Pause the video, try this on your own. If you have no idea what to do, that's okay. we are using this to learn. So let's go ahead and dive into the answer if you haven't paused the video already, and we'll learn how the Goodwill method works for when a new partnership is formed. All right, here we are. The answer is D. $150,000 is the total amount of goodwill that's going to occur because of this formation. So let's walk through it. It's actually not too difficult once you understand what the Goodwill method is. Under the Goodwill method, each partner is given the same initial capital as the partner with the highest contribution. That means that in this scenario, each partner's capital should reflect or be the same as Ben's contribution amount of $150,000. So again, what does that mean? Under the Goodwill method, basically you are bringing all partners up to the same amount of capital based off of the highest capital account of one of the partners. So Ben had a contribution of $150,000 that was greater than the other two. So they are going to have to be brought up to $150,000 so that they're all at an equal capital account. So pretty easily, you can figure that out. You take $150,000, which is the target for Alice and also for Chloe, and you subtract Alice's original $100,000. That would be the capital account balance for her if they were not using the Goodwill method. So she has $50,000 of goodwill that's going to be added to her capital account to get her up to $150,000. And then same thing for Chloe, $150,000 is what we need to be at. So we subtract her $50,000 actual contribution and we get $100,000 of goodwill. So total $150,000 of goodwill is occurring here when this partnership is forming and they are using the Goodwill method. So again, basically you are just bringing all partners up to the same capital balance as the partner with the highest capital balance, and you have to use Goodwill to do that. Now let's go to the next question. All right, here we are at question 4. What is each partner's ending capital balance after interest and profit sharing? Okay, let's go up to the top. Rebecca, Samuel, and Thomas are partners in RST partnership. Their average capital account balances for the year were as follows. Rebecca had $325,000, Samuel had $230,000, and Thomas had $215,000. The partnership agreement stipulates that each partner receives interest at 8% on their average capital balance for the year. After allocating the interest, any remaining profit or loss is divided equally among the partners. RST partnership had a net income of $150,000 for the year. So they are going to get interest based off of their average capital account balances, and then the income will be distributed after that. So pause the video. I don't think this one will be too difficult because you just kind of have to follow what it says in the question and you'll be able to figure this out. Go ahead and pause the video, come back when you're ready, and we will look at this together to figure out how the average capital balance and interest can affect somebody's capital balance. All right, here we are. The answer is C. Rebecca would have $380,467. Samuel would have $277,867, and Thomas would have $261,667. So let's walk through this. To calculate each partner's ending capital balance, we first apply the 8% interest to each partner's average capital balance, and then allocate the remaining profit equally among the partners. And that was basically said in the question. Now, just letting you know, this is kind of implied in the question. The fact that we aren't given their actual ending account balance before doing this basically means that we are assuming that the average that we were given is the amount that they had pretty much throughout the whole year. So that's why we're using that number to calculate all of this. And it's also the amount that we're adding the interest to after we do all this. So let's walk through it. Again, it's not too difficult. You take the average capital account balance that they each had and multiply each one by 8%. So Rebecca's would be $325,000 multiplied by 8%. That's $26,000 of interest. Samuel's would be $230,000 multiplied by 8%. That's $18,400 of interest. And Thomas's would be $215,000 multiplied by 8%. That's $17,200. So that is how much is going to be added to each of their accounts. But we do need to add up all the interest together because that is going to affect the profit. So add those all together, that's $61,600 of interest. This is going to be subtracted from the profit because this is kind of a way of saying you are guaranteed to get this interest no matter what the income is. So they are going to subtract it from the profit that there was, and that gets us to $88,400 left of profit after giving the interest. And then we divide it by 3 so that each partner gets an equal share of the remaining profit. So $29,467 is how much profit each partner is going to get. So now we can finally figure out all of their ending capital accounts. We take Rebecca's beginning $325,000, add her interest, and add her share of the profit, and that gets us $380,467. Take Samuel's, we get $230,000 plus his $18,400 of interest, plus his share of the profit, that's $277,867,000. And finally, Thomas, $215,000 plus his $17,200 of interest, plus his share of the profit. So that gets us to $261,667. So it's not too complicated as long as you're given the average capital account Now, we are going to go to the next question where we're going to have to actually calculate the average ourselves, and we're going to do a weighted average calculation in that one. But this is something that you might see on the exam, so make sure that you're paying attention to the order of these events. You do the interest first, that's taken out of the profit, and then you distribute the profit between the partners. So that's how you get to these different amounts. Now let's go to the next question. All right, here we are at question 5. What will Logan's ending capital balance be after applying the 6% interest? Okay, let's go up to the top. Logan and Mia are partners in Red Oak Ventures. Their partnership agreement stipulates that each partner receives interest at an annual rate of 6% on their weighted average capital balance for the year. Logan's beginning capital balance was $200,000 and Mia's was $150,000. The following changes were made to Logan's capital account during the year. April 1st, Logan contributed an additional $50,000. September 1st, Logan withdrew $30,000. So again, with all that information, and we've been keeping this in mind as we've been reading, right? What will Logan's ending capital balance be after applying the 6% interest? Okay, so this is a little bit different than what we were dealing with in question 4. In question 4, we were just given the average account balances. In this one, we're going to have to figure it out using the weighted average. So pause the video. If you have any experience doing weighted average in other calculations, you can probably apply something similar here. So try this on your own if you want, and when you're ready, come back, we will look at the answer together. All right, here we are. The answer is B. $233,650 is the amount of Logan's ending capital after the 6% interest. We were not dealing with the profit because we were not calculating Mia's weighted average, so we're only focusing on Logan's interest here. So let's go through the rest of this. To calculate his ending capital balance, we first determine his weighted average capital balance for the year, and then we apply the 6% interest. So to do the weighted average, again, this is something that you've probably done in other questions or other videos with me. You take the beginning balance, which was $200,000, and that was the balance that there was for 3 of the months. And then you take the $50,000 contribution that happened in April. So now the balance is $250,000 from April to August. So that's 5 months that is going to be the balance. And then on September 1st, he withdraws $30,000. So that is the remaining amount all the rest of the year for 4 months. So $200,000 for 3 months, $250,000 for 5 months, and $220,000 for 4 months. You could do that one of 2 ways. You can either do this calculation that I have right here, where you calculate 200,000 multiplied by 3 out of 12, 250,000 multiplied by 5 out of 12, and 220,000 multiplied by 4 out of 12. And that will give you these numbers, 50,000 plus $104,167 plus 73,333, and that gets you 227,500. You could also multiply 200,000 by 3, 250,000 by 5, and 220,000 by 4, and then divide all of that added together by 12, and that will give you the same number. So again, his weighted average capital balance after doing all those calculations is $227,500. Now we can calculate his 6% interest based on that weighted average capital account balance. So interest is 6% of that $227,500, and that's $13,650 of interest. That is going to be added to his capital balance. But don't forget, this is just the weighted average. This is not his actual ending account balance before we add the interest. So we do still need to go down and do the calculation. 200,000 plus 50,000 less 30,000, that gets us to 220,000. And then we add the interest, and that gets us $233,650 of ending capital. Again, this is before including profit, which would mean if you were going to do the profit, you would have to also figure out how much interest went to Mia so that you knew how much profit was left to then split between the 2 partners. But we're not going that far in this question. We kind of did that in question 4. And with that, we've learned a lot about capital account balances for pass-through entities, mainly for partnerships in this video. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep coming up in the questions. You keep seeing the same calculation, the same definition, or whatever the case may be. You see 2 or 3 questions trying to teach you how to calculate the initial capital balance of a partner in a partnership, or again, whatever the case may be. You notice these things throughout the questions, and you're not really focusing as much on the things you only see like once throughout the questions that you do that day. Again, you're focusing on the themes that seem to keep coming up, and you take a moment during or after you're studying, and you write these things out in your own words, kind of as a summary, the pillar topics of what you found was most important. And as you do this each day, you are building a repository, kind of a condensed version of notes in your own words of the most important things that you need to know for the exam. Now let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Again, this is kind of a summary of the most important things that you learned from the questions. So you might write down something different than I did, But again, this is a summary of the pillar topics that we just went over. First, initial capital contributions and adjustments. Partners' initial capital accounts are calculated based on the fair market value of contributions, with reductions for any liabilities the partnership assumes for that partner. Now, again, fair market value, that means that if non-cash property is donated, you use the fair market value. If it's cash, it's just the cash amount, because cash is just cash. $50,000 of cash has a fair market value of $50,000. So don't worry about that too much. Next, let's talk about the Goodwill method. The Goodwill method adds goodwill to the lower contributing partner accounts to match the highest contributor's balance when equal ownership is intended. So remember, basically you take the highest contribution, the person with the highest initial capital, and you're bringing everybody else up to the same amount with goodwill. Now let's talk about the bonus method. When a new partner's contribution results in more than the amount they invested, a bonus is added from existing partners' capital accounts adjusted according to their profit sharing ratio. So again, it's if somebody donated $40,000 worth of stuff, but they are getting a $60,000 interest in the company, that $20,000 difference is the bonus, and that $20,000 of bonus is going to be taken out of the other partner's capital accounts to then get the new partner up to what their new capital should be. And then finally, let's talk about interest on weighted average capital, or just average capital. This is something you may see. Partners may sometimes receive interest on a weighted average capital balance, which reflects changes from contributions and withdrawals at various times in the year. And remember, you're calculating the interest based off of this balance, and the interest is coming out of profit, and then you are dealing with the profit after you've already taken out the interest. So this part, the interest for weighted average and average capital balances, seems a little bit of a smaller topic, but I wanted to make sure that you still saw how to do it so that if you see it on the exam, you're not surprised. And with all that, we've gone over the pillar topics for this video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's free, it's 1 hour long, and we will teach you the key ingredients to passing the CPA exam without wasting months or even years of your time. Also, after you check out the webinar, you're going to want to become a pro member, and just remember that Superfast CPA Pro members get access to not only the Pro course, which is the big deal, where Nate walks through every single part of the process, step by step, detail by detail, exactly how you're supposed to be studying every day. Again, the Pro course is the big deal, but you also get access to the full 10-question versions of these 5-question YouTube videos. So Pro members can get more practice and a little bit more understanding by watching those 10-question versions instead of these 5-question YouTube videos. So make sure you check all that out. I hope this was helpful. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.